So on 1st January 2020, Zeus Limited raised finance by issuing a 2-year deeply discounted 2% bond. Oh, a 2-year deeply discounted 2% bond with a nominal value of 20,000, with a nominal value of 20,000. Now, there was a statement I'm supposed to make in this place. Let me tell you that quickly. I told you that the cash payment, you're going to use the coupon rate. That will always be expressed on the nominal value. Please take note of that. That will always be expressed on the nominal value. Always. Always. So the coupon rate, the cash payments every periodically will be expressed on the nominal value, but the effective rate will always be expressed on the initial value that you got. So please take note of that very well. Just wanted to clarify that, and let's go back. So it's a bond. 2% bond. Okay, what does that mean? It means that the 2% becomes the coupon rate. This is the interest we're going to be paying every year for the 2 years. So 2% bond means the coupon rate is 2%. With a nominal value of 20,000 Ghana cedi. So it means that the cash payment, the interest that we will pay every year is going to be 2% on this. So let me go to my slide, Zeus Limited. We can come up and bring in there, cash payment, and that's going to be 2% on the nominal value, because we have to express the interest rate always on the nominal value, and the nominal value here is 20,000 Ghana cedi. So times 20,000. What do I have on this one? Faster sound for me.
400.
What?
400.
400. Okay. So every year, interest that we will pay is 400 on this debt, because the coupon rate is 2%. Let's go. That is issued at a discount of 5%. The bond in question was issued at a discount of 5%. What does that mean? It means that even though the nominal value is 20,000, we did not get 20,000. It was issued at a discount of 5%. It means that, the proceeds that we had from the issue, or if you want the fair value, is going to be at a discount of 5%, meaning we did 95% of that figure. So we can take 95% of the 20,000. Sounds good? So the actual money we got is 95% of the nominal value. Again, get a context of the question. That is issued at a discount. When we issue a bond at a discount, it means we issue it below its face value. It means it is issued below the face value. Face value is the same as nominal value. So when we issue a bond at a discount, we are issuing it below the face value. So it means the actual money we got will be 95% of 20,000 Ghana cedi. What do we have for 95% of 20,000 Ghana cedi?
19,000.
19,000 Ghana cedi. So this is how much we got from the debt that we issued. Then we are told that and is redeemable. Oh, is redeemable. Okay, so if it is redeemable, we don't need any miracle. We go back to our golden rule. Golden rule says, does the entity have an entity to redeem or to repay the instrument? In this question, it is what? Yes. So if it is yes, it means this instrument by Zeus will be recognized as a financial liability because it is redeemable. So it's a financial liability because it is redeemable. But it is redeemable at a premium of 2,100. Please note, bonds can be redeemed at one, their nominal value or face value, or they can also be redeemed at a premium. When it is redeemed at a nominal value at the face value, it means the same as how much the people gave us. But if it is redeemed at a premium, it means that is above the nominal value. Now, you don't redeem a loan note at a discount. It's rarely done. But if there is, it means you redeem it below the nominal value. But that's not done. You can issue at a discount, but you don't redeem at a discount generally. You don't redeem at a discount because the one who gives you the money will not be willing. Unless otherwise the time is not yet due and the person wants his money. Then in that case, you redeem it at a discount. So, but at the time of arranging the contract, that is out of the question. So really redemption at a discount is out of the story. But we can redeem at the nominal value at the face value. And then we can also redeem at premium, which is above the nominal value. So we can redeem at a premium of 2,150. We will come to that in a moment. There were no issue costs. Okay. So it means that the initial value will still be 19,000 because there was no issue cost. There was no issue cost. That is a good story for us there. The bond has an effective rate of 10%. You see that? The reason why the effective rate is coming in is because one, we are redeeming at a premium, and two, we issued at a discount. So really, the interest rate implicit in the loan is actually the 10%. It's actually the 10%. So this is our initial measurement. If we want to, then we were not told, okay, the year ended is 31st December 2020. So we will prepare the amortized cost schedule. So with the amortized cost schedule, like we mentioned, we're going to be bringing in the year ended. We'll bring in the balance brought forward. We bring in the interest. Now here, you see that the examiner didn't tell us when the interest is supposed to be paid. But like I said, by default, interest on bonds must be paid in arrears, must be paid at the end of the year. So we're going to be bringing it there. So you bring in the interest. Then you bring in the cash that will be paying. Then you bring in the balance carried out. So our year ended under review for the context of this question is 31st December 2020. So we bring that up, 31st December 2020. The balance brought forward will be the proceeds we had since there was no transaction cost. That will be 19,000. Then our effective rate implicit in the lease is 10%. So 10% of 19,000 will give us an amount of 1,900. Then the cash payment, which we calculated in the first part of the question, that's going to be 400. So you less that out, and we get the balance carried down. So you add the 19,900 to the 19,000, then you subtract the 400 from it to get our closing balance. To get our closing balance.
2,500.
Sorry?
2,500.
Right. So for the year ended 31st December 2020, this is what we have in relation to the question. So if I want to extract my financial statement, very simply here, statement of profit or loss, that's an extract. I'm going to bring in finance cost. As a lazy student, I didn't number my work, and that is 1, 2, and then 3. So that the finance cost will come from working 3,900. It's an extract, so you can leave it like that, no problem in relation to it. There is no cause for alarm. Then in the statement of financial position, which in this case happens to also be an extract. Remember, this debt is just 2 years. So it is redeemable in the following year, less than 12 months. So on the face of the statement of financial position, it will be under current liabilities. And we'll bring in the 2% bond. And that will be the carrying amount from workings 3, which is the 20,500. 20,500. And that is the idea about what we do in the context of this question. Now, let's say that we are doing for the final year, how will the amortized cost look like? That is not in the context of the question, but how will the amortized costs look like in the final year, since it is just 2 years. So we'll have 31st December 2021, and the closing balance for the 2020 becomes the opening balance for the 2021. So we bring in 20,500. Then we get an interest rate on that. 10% of that, that'll be 2050. But then in the cash payment side, 2 things are going to be there because this is the date of redemption. So we're going to pay the 400 to them. Then they're going to get their 20,000 plus their premium. How much was the premium? 2,150. Okay, so we're going to pay all these up, 2,150. So in the last year, the balancing figure will be nil, assuming we get everything right. If you don't get 0, like you may get some amount because of approximation generally. So on the date of redemption, you can work it out and it should give you nil or a figure that may not be considered as significant, a figure that may not be considered as significant. That is the idea about the amortized cost schedule.